Well, hey, everybody, welcome to the program. We're going to talk about student loans today. And it says more on student loan forgiveness because I actually fairly regularly give presentations on student loans at the Kansas City, Kansas Public Library. And so we had planned on this, the administration with the library and myself, that we knew that the Supreme Court was likely going to give a ruling on blanket loan forgiveness. And we knew there'd be a lot of interest in this topic once that happened. And so that's why we're here giving additional information. And the great thing is once the Supreme Court gave the decision on blanket loan forgiveness, we are essentially at a point now where we have a lot of clarity on things that we didn't before. Actually, the day that the Supreme Court essentially gave their ruling on blanket loan forgiveness, we got almost an immediate announcement from the Biden administration clarifying things like the new income-driven repayment plan, for instance. And so I'm going to share some detail on that and give you links that you can follow up with additional information if any of these topics are of interest to you. So let's get started. The first thing that I want to do is just talk about a little bit of a disclaimer. I wear many hats in my life, and one of the hats that I wear is as a professor at the University of Kansas. Then I also do a lot of student loan planning stuff, and I have a consulting business in student loan planning called Gradmetrics. And so KU likes for me to make clear that I'm wearing my Gradmetrics hat in this presentation. I'm not representing KU. Okay, so recent news. Before we get there, I just want to clarify, I'm sure you know, but there are two types of student loans that exist out there. You can go and get student loans from the free application for federal student aid, otherwise known as the FAFSA. And the FAFSA in particular essentially will give you federal student loans, loans that come from the government. Now, they may be dispersed by your college, but you're essentially getting them from the government. And when you graduate or when you drop out of school and you have to start paying on your loans, you can go and find information from the federal student aid website. You can look at your loans. The servicers are assigned by the federal government. So that's where the Department of Education comes in. So that's federal student loans. We also have private student loans. So this is if you went out and got a private student loan from a bank or credit union, or sometimes like a Sallie Mae, larger providers that are in this space. And so if you have that type of student loan, unfortunately, we're not going to talk too much about it because those loans tend to be more like a car loan or a mortgage loan. A lot of the strategies out there to pay them off are going to be like just normal debt. There's not a lot of incentive programs or loan forgiveness opportunities for that debt. So we're really going to focus on federal student loan borrowers, which is the largest piece of the pie, by the way. So most of the folks on the call are probably looking at that. When it comes to federal student loans, we have subsidized loans. These are loans where the government pays for the interest while you're in school. Sometimes there's also additional subsidies that you even get for having subsidized loans post-school. And then we have direct unsubsidized loans. This is where you start paying interest immediately, at least in kind of a normal world. A lot of people that have federal student loans haven't paid any interest for over 3 years because of the COVID forbearance. But in normal times, which we're getting there, come October, we'll be back to normal times when it comes to student loans. You will pay interest on unsubsidized loans immediately when you take them out. Okay, so that's just a primer, making sure we're all on the same page. Now let's talk about what's happening in student loans. And by the way, in my historical presentation I've given for the library, this is at the end. But now this is what everybody wants to know is what's going on in student loans. How does this affect me? So you probably know, and the reason why you're on this presentation is that about a year, I believe it was about a year ago, the Biden administration announced some pretty sweeping initiatives in student loans. And it was actually 3 pieces, but most of the people were focused on this idea of blanket loan forgiveness, which was one piece. The other pieces were the extension of the payment and interest pause that had started in COVID-19. The other was a new income-driven repayment plan, which now we have details on that. And we're going to talk about it. But at the time, we're like, great, new income-driven repayment plan. We have no idea what it's going to be like, but we knew it was coming. And so now we have details here. But unfortunately, or depending on what your opinion was on this, the Supreme Court essentially took up the matter of the blanket loan forgiveness, and they denied it this month. And so, or sorry, last month, it was June 30th. So it was denied by the Supreme Court, which means this blanket loan forgiveness initiative no longer exists. What that was going to be is for individuals of a certain income range, you were going to get $10,000 forgiven from your federal student loans, and in some cases $20,000 for individuals who displayed a lot of financial need when they went to school. In other words, they got the Pell Grant. So this is no longer around because it was struck down by the Supreme Court. And I did, by the way, 2 days ago, I wrote an article for the Kansas City Star that is now published. So if you go to Google and you just search Jason Anderson, student loans, Kansas City Star, you will see that article. And I talk a lot about what happened in the Supreme Court and what you can do now, which of course we're going to cover in this presentation as well. But if you want a good reference, remember that you can always go back to that Kansas City Star article. I cover a lot of this stuff there. Okay, so what now? So the Biden administration got dealt a pretty severe setback on their loan forgiveness plan. Many people were planning on this because if you were like me, by the way, I have federal student loans. I'm a doctoral student at Kansas State University. So I have loans, and I got an email from the Department of Education saying, hey, you're approved for forgiveness. And many of you all got that too, but of course that's not going to happen anymore. So many of you all on this call were planning for forgiveness that's not going to come anymore. So what can you do now? Well, first off, I'll say the Biden administration might try again, okay? Now, I wouldn't put a lot of, and personally, I would not put a lot of weight into this because the discussion right now is that the Biden administration is going to try through the Higher Education Act. They're going to do probably the same thing, and they're going to do round two. Well, if you read the opinion of the Supreme Court or you read articles about it, the Supreme Court really struck it down because they considered it executive overreach. That essentially the theory being that if there's going to be loan forgiveness, it should come from Congress, not from the president. And so let's say the Biden administration tries again and they go through a different law, but they try to do the same thing. My guess is it's going to end up at the Supreme Court and get struck down again, regardless of what law, because the same theory still applies. Now, I'm no legal expert, okay, but that's my theory. And so I'm not putting a ton of weight into that, but I think the Biden administration will try again. So what do you need to do in lieu of getting forgiveness? You should revisit your monthly budget. The reality of this situation is that we have been in a payments and interest pause since the beginning of COVID-19 and the Trump presidency. It was March 2020, believe it or not. So many folks that have qualifying federal student loans haven't paid interest, haven't paid anything during that time. So you've likely picked up other financial commitments during that time. You've reallocated what you would be spending on student loan payments to maybe a nicer car, maybe paying more towards your child's education expenses, whatever that is. So now you're going to have to reallocate that back to student loans. So you need to revisit your budget. I mean, I know that sounds very kind of common sense, but you need to do it. And you need to do it before September or October when these things start to kick back in. Because when are you going to have to actually start making payments again? Well, that's going to be the restart of payments are going to be in October. And actually, you're going to have to start paying on interest a bit sooner. So September 1, interest starts to accrue again. So your loans are essentially going to get more expensive because interest will start to accrue just like normal loans. So and now many of you all are saying, hey, well, I looked at the budget and I don't have money. I can't make payments again. What am I going to do? And for those that say that, I would say you need to look into income-driven repayment plans. And there's a way that you can figure out if these will be a good fit for you. So let's look at the next slide. By the way, this is just the link to my Kansas City Star article that I was mentioning earlier. So actually, let's get back to the SAVE plan, but I'm going to go a couple slides ahead. So for those of you that are like, hey, is an income-driven repayment plan a good fit for me? The federal government created a very nice student loan repayment simulator tool that you can access for free. And guess what? You can take your student loan data file, you can log in with your information, and it will give you customized results for you. So you go to studentaid.gov/loan simulator, you log in, and it's going to say, hey, you have these loans, they're these type of loans. These are the income-driven repayment plans that are available to you. These are what the payments are going to look like in each of these plans. Here's how you actually enroll in an income-driven repayment plan. So it's going to give you everything you need, okay? So for those that want to pay a student loan planner like me for a customized plan, more power to you. It keeps me in business. But for those of you, and many people cannot pay someone like me to do a customized plan, this is going to be the next best thing, okay? And it is free, and it is available for your use, and it is an excellent tool, okay? So if you're like, hey, I can't afford my payments, I need to look at something else, I'm in a standard repayment plan, I would look at that loan simulator and I would see what's the best fit for you and what you might be able to go into. Because the truth about, and we'll get into income-driven repayment plans here in a second, the truth is not everyone qualifies for every plan. And so using the tool simplifies the process of figuring out whether you're eligible for a plan or whether you're not. Okay, so I mentioned that we now have details on Biden's new plan, which is called the SAVE plan. And that's an acronym, which is all income-driven repayment plans are acronyms, and it's really confusing and it's really complex, but it's called the SAVE plan, S-A-V-E. The details have been announced, and so now we have clarity on what this plan looks like. And spoiler alert, it is an awesome plan, especially for undergraduate loan borrowers, okay? So we're gonna go through the details and how this kind of compares to current income-driven repayment plans on the books, but it is an awesome plan. I'm just gonna throw that out there. So for those of you that are already in revised pay-as-you-earn, which is this REPAYE that you see on the screen, for those that are in that plan, you will actually be transferred to SAVE automatically, okay? So you don't have to take any action. Essentially, SAVE plan is going to replace revised pay-as-you-earn. For those that are in pay-as-you-earn, that plan is actually going to, well, I shouldn't say it's going to go away, but people aren't going to be able to enroll in that plan anymore. Why? Because SAVE is an excellent plan. So the Biden administration is essentially replacing revised pay-as-you-earn. It's now going to be the SAVE plan once everything gets up and running. And then pay-as-you-earn is no longer going to be something you're going to be able to enroll in. Okay, so what are the changes for the SAVE plan? Well, the first thing is that I'm going to simplify this, but these are the details. This is actually from the chart, from that link in the previous slide, okay? So we're going to walk through each one of these. So the SAVE plan, essentially, if we think about how income-driven repayment plans work, they are going to protect a portion of your income as income necessary for everyday needs, okay? Then they're going to look at your discretionary income, which is income outside of what you need to live. And then they're going to assess a piece of that income is going to go towards paying on your student loans, okay? So from a high level view, that's how income-driven repayment plans work. So we have what's protected as not going to be assessed for paying on student loans. We have the amount that is going to be assessed towards paying to student loans, and then we have the percentage of that amount that's actually going to be your payment, okay? So what does the SAVE plan do? Well, the SAVE plan actually increases the amount that is not going to be assessed to pay for student loans. So it goes on the poverty line, and essentially it increases from 150% to 225%. So you get more income that's protected. That's benefit number one of this plan. And that is better than any other plan on the books, by the way, right now. Then it's going to take essentially also it's going to look at interest. So you have to pay interest on student loans. And sometimes people that are in income-driven repayment plans don't pay enough to even cover the interest on their loans. And so what does that do? Well, their interest balloons pretty significantly over time. Well, the SAVE plan actually protects against that. So as long as you're making your monthly payment, your balance won't grow, okay? There are other perks to the plan. This is just a piece of the table. I thought I screenshot all of it, but I know there are some other things here that aren't showing. So there are a few other things. You're going to get a shorter period towards loan forgiveness. So if you pay on your loans for a given amount of time, you will get forgiveness if you still have a balance. And so the SAVE plan, especially for undergraduate borrowers, that window is shortened, okay? So it's going to be really good for undergraduate borrowers in terms of forgiveness. We call that long-term loan forgiveness. When you complete the term of your income-driven repayment plan, you can get forgiveness. So shorter period there. We also have the ability to separate out spousal income. And so if you don't make a lot, maybe you work for a nonprofit, but your spouse is a doctor and makes a ton, you can actually separate out income in that case. So a number of different benefits. We also have a significant percentage of, I should say a smaller percentage of your income that's going to be allocated towards student loan payments. So, okay, you're like, Jason, this is all really technical. What do we need to know? Well, for undergraduate borrowers, the SAVE plan is incredible. For graduate borrowers, it's still pretty darn good, okay? So for both, really for just about anybody, the SAVE plan is definitely something that you want to look into and likely enroll in. If you're in a place where you're either going for forgiveness, like public service loan forgiveness or long-term loan forgiveness, or if you're struggling to make your month-to-month payments. Make sense? Okay, so the SAVE plan is awesome, all right? And how do we know if we should be in an income-driven repayment plan, or what the terms will look like, or what our monthly payment will look like? Just go to the federal repayment simulator. You'll put in your information. It will create a customized plan for you, okay? All right, so that's really what you need to know. That's really the actions that you need to think about and take now that we are in kind of this post-Supreme Court decision era in terms of student loans. So now I'm just going to drill deep into income-driven repayment plans. I'm going to drill deep into forgiveness opportunities, and I'm going to drill deep on a few additional initiatives that the Biden administration has put forth that could be beneficial to you as you think about repaying your student loans. Okay, so what repayment plans do we have? So we have to repay our student loans, right? We can't not pay. There are pretty bad consequences if we don't pay on our student loans. And so the Department of Education knows this, and they give us various options to pay on our student loans. And so one of those options is the standard plan. And so one of the reasons why I'm kind of continuing to emphasize that you might want to get into an income-driven repayment plan, if it's a good fit for you, is because most people are in the standard plan. This is the default plan that you're put into once you start paying on your student loans, at least for now. And historically, it's been the default plan that you've been put into. And so for most people, they're going to be enrolled in this plan, and is essentially just paying it off in 10 years. So your payment is based on your balance that you have and paying off that balance in 10 years. There are a few modifications of this plan, like graduated repayment plan, the extended payment plan. This is where you pay less at the beginning and then more as the loan ages, or you might pay over a longer period of time, but they're modifications of the standard plan, okay? Now, interestingly, public service loan forgiveness, you really need to be in an income-driven repayment plan, because that's what's going to give you the biggest benefit in terms of forgiveness. And also, in many cases, they're the only plans that qualify for public service loan forgiveness. So make sure that you know what payment plan you're in if you are going for public service loan forgiveness. I'm going to say that again later in the presentation, but that's something you need to keep your eye on. The standard plan, by the way, I think technically qualifies for public service loan forgiveness, but it's payoff in 10 years. And public service loan forgiveness is essentially a 10-year plan, okay? So you're not going to get any benefit. So most people going for public service loan forgiveness are going to be in an income-driven repayment plan to maximize the amount of forgiveness they'll get at the end of 10 years. So then we have income-driven repayment plans. And these are the ones that are currently on the books, which addition to SAVE, which is coming. So we have pay-as-you-earn, revised pay-as-you-earn, the SAVE plan. Again, these are going to change a bit because of the SAVE plan being introduced. We talked about that. We have income-based repayment, IBR, old and new. We have income contingent repayment plans. These tend to be for Parent Plus loan holders, for instance. And then we have income sensitive repayment. Trust me, I've done a lot of student loan plans. I've never seen that plan in practice. And so I should probably strike it from this presentation, really, but I'm trying to be comprehensive here. And so you're mostly going to see the ones above. These are the income driven repayment plans. And again, they vary in terms of those different things that we talked about earlier. What percentage of your income is protected? What percentage is going to go off to pay your student loans? Sometimes it's 20%, sometimes it's 10%, soon to be 5%. So each of these have different stipulations depending on the plan. And you can go and look at all these details on the federal student aid website. But again, I think the easiest way for most non-technical users, people that don't do this every day like I do, you should just go use the loan simulator and see what it calculates for you, right? Most of us are not doing calculations by hand. We go online, we find a calculator that's going to give us our answer, and we use that calculator. And so I would encourage you to do that in this case as well. So those are the different ways that we can pay on our federal student loans. Now let's talk loan forgiveness. What are the opportunities out there to get your loans forgiven over time? Well, the first thing that you probably heard of, and many on the call are probably trying to get a refresher on this, is public service loan forgiveness. These are for individuals who are in government, non-for-profit organizations, military, public service organizations. They have the ability, after 120 qualifying payments, to get their balance forgiven. So it's a really, really good program. I mean, think about it. You went to law school, you go and you're a lawyer for the SEC or some kind of government entity, or you go work as a public service lawyer for a nonprofit or a public defender. A lot of those people don't make a ton of money. And so they've taken out tons of debt to get that degree, and they're doing a public service. And so they want to get some forgiveness. And so that's what this is meant to do. Or undergraduate individuals who go off to work for a charitable nonprofit organization. And so those individuals do get the opportunity to get loan forgiveness. The waiver program ended, and it looks like I didn't finish my sentence, so I'll finish it here. But there was a really cool temporary program called the Public Service Loan Forgiveness Waiver Program that ended last year. So you can't enroll in it anymore, but now we have something called the Income-Driven Recount Waiver Program. That's not exactly what it's called, but it's got a technical name, and it essentially, for many people, will function a lot like the waiver did. So if you're somebody on the call and you're like, hey, I should have done the waiver program, I missed it, you now have an opportunity through the Recount program to potentially get the same benefits, okay? So we're not going to get too technical on that, but just know that program exists. We'll talk about it a little bit more as the program goes along. If you're a teacher, you should know that you have opportunities to get forgiveness through teacher loan forgiveness. This is if you work in a low income or like kind of more of a high risk. I forget the exact term here that it's a designation that's given by the Department of Education, but low income elementary, secondary, educational service agencies, you get the opportunity to get forgiveness after a number of years. If you've been in a for-profit school and that's where you got your education, sometimes you're able to get forgiveness through borrower's defense or closed school. We saw that with like ITT Tech, for instance, and Corinthian colleges. And then sometimes you get discharge of your debt through death or disability. Or if you're a Parent Plus holder, for instance, if you took out debt on behalf of your child and they die or become disabled, you might get the opportunity, and in many cases do get the opportunity to get your debt forgiven. And then I say bankruptcy, but bankruptcy is really rare, okay? Not to say it doesn't happen, but that's a pretty high bar because educational loans in particular, both federal and private, are protected classes within the bankruptcy process. And so it's not something easy like credit card debt, for instance, that you just go to bankruptcy and get it wiped away. Not that I'm saying bankruptcy is easy on anyone, but it's extremely difficult to get your loans discharged in the bankruptcy process. Again, I'm not a lawyer, but I know enough to know it's pretty difficult. And then don't look past state loan forgiveness opportunities, okay? So I'll just give one example. Here in Kansas, if you live in a rural zip code, or I would say a rural zip code, but there are designated rural areas within the state of Kansas that if you live there for a certain amount of time, you can get forgiveness on your student loans. Not all of them, but I think it's like $16,000 or $17,000. So a significant amount of money if you live in a rural area in Kansas. Many states have programs just like that one that incentivize people to maybe move to rural areas or practice in certain professions like medical professions. So keep that in mind and go to your state's agency. So for instance, the Kansas Board of Education here in Kansas, or the Missouri Department of Higher Education in Missouri, and look to see what programs might be a good fit for you. All right, so I'm going to take a pause here. You can all take a breath. All right, so now we'll talk public service loan forgiveness. So public service loan forgiveness, will go in a little more detail here for those of you that are on the call and interested in this program, think it might be a good fit for you. So public service loan forgiveness really has four main tenets or qualifiers. We'll call them that. So first thing is you need to have direct loans. This is a specific type of federal student loans. Basically all new federal student loans are going to be direct loans, but there are older loans that are not direct loans. And so you have to ensure that you have direct student loans. The second is that you work or that you're under a qualifying repayment plan. We've already talked about this a little bit, but you can't be in like a graduated repayment plan. It won't qualify. Most people in going after public service loan forgiveness are going to be in an income-driven repayment plan, and most of those qualify for public service loan forgiveness. Then you need to be working full-time for a qualifying employer. So this would be nonprofit, military, government, state, federal, local, tribal, all of those. And then there's even public service entities that may not fall in those categories. That is kind of another umbrella you could fall under. You have to be for a qualifying employer. In other words, you can't get this if you're working for a corporation, for instance. And you have to be working full-time, which this is defined by your employer. It's not defined by the Department of Education. So whatever your employer considers to be full-time is what's going to be required here. Then you have to make 120 qualifying payments. And so you've probably heard of public service loan forgiveness as a 10-year program. And so if we divide 120 by 12, you get 10 years, okay? But I do say 120 qualifying payments because these don't have to be sequential. And I think when we talk about public service loan forgiveness as a 10-year program, people get confused and they think that you have to pay 10 years sequentially, and that's just not the case. So you have to make 120 qualifying payments. By the way, I also say this because if you fill out the public service loan forgiveness paperwork and you've kind of raised your hand to your servicer in the Department of Education that, hey, I'm in line for public service loan forgiveness, they will start updating your student loan data file saying, hey, well, you have 10 qualifying payments. You have 40 qualifying payments. You have 110 qualifying payments. And so you can actually track your progress towards public service loan forgiveness and have peace of mind that you're making progress. Because it wasn't too long ago that people were trying to get public service loan forgiveness and they were being rejected in extremely high numbers. So now we don't really have that issue as much because we can say, oh, well, I can see in your student loan data file that you have 70 qualifying payments. So we have that now, whereas we didn't have that historically. Okay, so each of these we're going to go through just briefly. You have to work for a qualifying employer. Again, this is federal, state, local, tribal, nonprofit organizations. It could be full-time in the AmeriCorps or Peace Corps as a volunteer. It could be qualifying public services, and you have to be full-time, defined by your employer. So if your employer defines full-time as 35 hours, that could be full-time, even though we kind of consider full-time 40 hours and in many cases, but it's really more defined by your employer than defined by law, for instance. You have to be in the right repayment plan. We've already talked about this. So make sure if you're in an income-driven repayment plan that it qualifies for public service loan forgiveness. And if you're going for public service loan forgiveness, you're likely going to want to be in an income-driven repayment plan. So you need to make sure it's qualifying, and then you're likely going to be in an income-driven repayment plan to maximize your forgiveness. You have to be in the right loans. So what are the right loans? The right loans are the William D. Ford Federal Direct Loans, okay? And if you log in to your student loan dashboard at studentaid.gov, and it does not say direct in the title of your loan, you likely need to take action, okay, to qualify for public service loan forgiveness. And again, I told you the waiver program allowed us some flexibility if you weren't on track to correct that, if you were in an old loan type. And now the income-driven readjustment program will give us that opportunity. But these are both limited programs in terms of time, okay? So you can't sit around forever and just hope that these will be around. Many of them are time sensitive. So if you log into your dashboard and you have FFEL loans, for instance, the Federal Family Education Loan, you have Perkins loans, et cetera, older loans that aren't direct, they don't have direct in the title, then you likely need to take action. You probably are not making qualifying payments for public service loan forgiveness. You need to take action in order to get credit, okay? And the current programs on the books are time sensitive, so you need to take action sooner rather than later. Thank me later, by the way. I have talked with individuals who missed programs that would have been beneficial to them, and it's not a fun place to be in, okay? All right, then you have to make qualifying payments. So qualifying payments are defined as full payments. They have to be made after when the program was initiated. You have to be required to make that payment. In other words, you can't get credit during like a grace period. And you have to be under the right repayment plan. You have to be under right employment, and they have to not be late. So we've talked about a few of these, but this is what it means to make a qualifying payment. Okay, so I've talked about the account adjustment, right? So we talked about the PSLF waiver program, which expired in October of last year. So good riddance, we can't do that anymore, okay? And if you got to be a part of it, that's awesome. If you didn't and missed out, we still have a chance to maybe rectify that, okay? And that tool is the IDR account adjustment. And so what does this do? Well, it's really meant to correct servicer mistakes. So historically, servicers sometimes too easily put people in forbearance, and their loans ballooned, and they were essentially penalized by interest charges and all sorts of stuff. So it's meant to correct servicer mistakes. But what's happened is this program has broadened significantly, and so now we have opportunities to not only to get additional payments that might qualify for what we call long-term loan forgiveness. So I'd mentioned briefly earlier that if you're in an income-driven repayment plan and you pay to the end of that period, that you'll get forgiveness after you've gone to the end of that period, like 10 years, 20 years, 25 years. And so this will give you potential credit to get closer to long-term loan forgiveness in an income-driven repayment plan. That's really what it's meant to do. But it also might get you opportunities to get additional payments towards long-term loan forgiveness by doing some consolidation. Now, I'm not saying you should consolidate, but in certain instances, it might make sense. It might make sense for individuals who have those older loans that want to get credit for public service loan forgiveness. It's good for those that miss the public service loan forgiveness waiver. But a big disclaimer here, big asterisk, okay? I would tell you that just consolidating because I said consolidation, probably not in your best interest, okay? You need to make sure that if you're consolidating, there's a specific reason under this program as to why you're doing it, okay? So that you're not penalized for doing it just for no reason, okay? So this could be a really beneficial program, but the big if is you need to know where you fall within this program, and it's pretty complex. So you need to either go to this link, read the details. You need to look at engaging somebody that knows something about this. You need to do your homework, okay, before you take action under this. But the good thing is that it will be beneficial for people who missed out on the public service loan forgiveness waiver or have graduate and undergraduate loans with different qualifying payment counts, all sorts of cool things you can do under this program. All right, so for those of you that are like, hey, Jason, this sounds great. I want to go for public service loan forgiveness. What do I do now? Well, it's actually a pretty easy process. You go to studentaid.gov/PSLF and you fill out the paperwork, okay? And I also encourage clients or people that I talk to about student loans that you I encourage them to fill it out every year, every couple of years, because as you continue to fill it out, you're going to get that payment count updated on your student loan file, and you'll have peace of mind that you're making progress towards public service loan forgiveness. Because, hey, it's pretty nerve-wracking to go to think you're making progress towards a 10-year forgiveness program and to not know where you're at in that process. So fill out the paperwork and get that payment count updated, that qualifying count towards public service loan forgiveness, so you get peace of mind that you're making progress. Okay, I mentioned a little bit, if you went to a for-profit school, there are some initiatives out there. Some of them are automatic and some are ones that you have to qualify for that will give you forgiveness for going to a school that the Department of Education has essentially identified didn't do a good job in terms of the way that they handled the student loan program, in terms of the things that they sold to people that went to these schools as maybe employment opportunities and things like that that didn't pan out. And so if you went to a place like Corinthian Colleges, ITT Tech, Westwood, maybe you were covered under a settlement. In any of those cases, you likely either got automatic forgiveness in these cases, or you can maybe qualify by filling out an application, sending it to the Department of Education saying, hey, I don't think the school that I went to was maybe selling more than what they delivered, or they essentially were engaging in fraud. You can get some forgiveness in those instances. And I have encouraged a few people to fill out those applications over time. All right, so other student loan issues. It's becoming more common that employers offer some type of assistance to pay down your student loans. And part of this is because of tax law changes and things like that. So if you're looking for a job, see if this is a benefit that could be offered to you. It could be beneficial. The next thing I would say is if you've gone through this entire presentation and then you realize that you have private student loans, almost everything I've said here does not apply to you, okay? So what does apply to you? If you have private student loans, really the strategies that we talk about as financial planners or financial advisors or student loan professionals are going to be what you would use for any debt, your car debt, your house debt, your credit card debt, and those are the debt snowball and the debt avalanche. So the debt snowball is where you start looking at your smallest debt first, you start paying that off, and you move on to larger debt balances. This is more of a momentum play. Now, you still have to pay your minimum payments across all of these debt classes, okay? You can't just not pay on one and let it go into default. That's not what you want to do. We pay minimum amounts across everything, but then you start allocating your extra dollars to pay down the lower balances, and you feel the momentum when you start checking off those loans and you're paying them off. Now, if you want to be more efficient than that, as in you want your dollars to be maximized throughout this process, then you go for what we call the debt avalanche, okay? And the debt avalanche is when you pay on your highest interest first. So you're still paying your minimum payments, but then you attack the loans that have the highest interest rate. Now, these may also be the loans that have the highest balance, okay? So it's not a momentum. You may not feel as good doing this, but your dollar is starting to chip away at the highest interest debt, moving to the lowest interest. And then you're eventually going to get to a place where hopefully you're getting those high interest rates down to the lower interest rates, and your dollars will pay off more of the debt, essentially. So it is kind of still a momentum play, but it just may not feel as good as you're playing, as you're paying off. Then there's consolidation and refinancing. So I've talked about consolidation throughout this program. What is that? Consolidation is a government program where you're taking federal student loans, you're consolidating them, and it's really not to save on interest, because the government's actually going to take a weighted average of your interest rates. They're going to tick it up 1/8 of 1%. You don't need to know that technically, okay? But essentially, it doesn't save you on interest when you consolidate. It actually hurts you a little bit. Whereas that's different than refinancing, okay? Refinancing is just like any other debt. When you're taking debt, you're paying off that debt with something else, maybe to try to save on interest rates, or maybe to put everything together where it's one payment. But this is where you're maybe taking a federal student loan, refinancing it with like Commerce Bank, and then now your debt is with Commerce Bank. Big red flag here. You may save on interest, but probably not in a higher interest rate environment that we're in. And the other thing that I would say is once you take federal student loan debt, you privatize it to a bank or a credit union or what have you, even if you're saving on interest, these programs that we talked about for the last 45 minutes go away for you, okay? So before you consolidate, before you refinance, know what you're doing. That's why I put these in this last slide. Don't just do it willy-nilly. You could be in a place where you really cripple yourself in terms of programs that can be beneficial to you. All right, so additional resources, where can you go for help? The Department of Education has a hotline you can call and ask questions. That's 1-800-4FED-AID. By the way, this is also a hotline you can call when you're filling out the FAFSA if you have questions. Now, is it super consumer centric? Is it great customer service? I don't know. You have to tell me. Most government hotlines are not, okay? But it's there if you need it. And I would say, bar any other resource, studentaid.gov is where you need to go. This is published by the Department of Education. It is an amazing resource. It's the image that you're seeing here on the slide. So everything student loans, go to studentaid.gov, okay? I also have a blog at gradmetrics.com. I do publish every once in a while. I have lots of information on this website, so feel free to check that out. But again, studentaid.gov is where I encourage people to go. Most of this is just me talking about what's there, okay? And clarifying it and summarizing and things like that. But you can always go to gradmetrics.com. I also have a podcast, although I haven't updated it in a long time. I'm likely going to restart it now that the Supreme Court has essentially given their decision on student loan forgiveness, but it is a little old at this point. Hopefully I'll update it soon. And then here's my contact information. So you can call or text that number. Also, jason@gradmetrics.com is my email. Feel free to email me if you'd like, or text or call if you have additional questions, and I'll be fielding questions as we go along here as well. Okay. So Elena, I'll go ahead and look at the chat if you want, or I don't know how you want to field the questions.
Yeah, let's look at the chat. Ooh. Okay. Do we need to sign up for the income-driven repayment plan before we sign up for the public service loan forgiveness?
So no, you can actually do, you could do one before the other. But like I said previously, most people who are going for public service loan forgiveness want to get the maximum amount of forgiveness possible, right? That's the name of the game when you're going after public service loan forgiveness or long-term loan forgiveness. And so they're going to want to be in an income-driven repayment plan because it's likely their lowest payment. And I will tell you, I saw in the chat as well, where someone says, hey, does it make sense for me to apply for public service loan forgiveness when I may pay it off before 10 years? There are some online calculators where you can look at kind of what your payoff is going to be versus 10 years to see if you get some benefit. But certainly I can't give a yes, no answer to that because there's a number of factors. You may be able to get more of a benefit by going to an income-driven repayment plan. You might be able to a number of different things. There may be some opportunities under the recount, IDR recount, that will maximize your number of payments, get you closer to 10 years. So there's a number of things there that would add to the complexity of that question, but there certainly are some things to look into before you just strike out public service loan forgiveness is not an option for you.
What information do we need to find our student aid dashboard?
Yeah, so if you go to studentaid.gov, there is a login where you can log in and look at an overview of your student loans. Now, this is going to be the same login that you used when you were filling out the FAFSA, which you also logged into the FAFSA at studentaid.gov. So studentaid.gov is your one-stop shop from a government perspective to get an understanding of financial aid and student loans. Now, I will tell you this is different than your servicer's login, right? So you're going to have the dashboard for your student loans at studentaid.gov. You can log in with your FSA ID, but you'll also have a servicer login, which will also show your loans, but you might have multiple servicers, by the way. It will show your loans, and that's where you're going to be making payments, okay? So both have their uses. For instance, if I'm working with somebody on a student loan plan, I'm asking them to go to studentaid.gov website, and I'm asking them to download their data file, which has lots of great information. You can't get that on the servicer website. You also can't make payments on studentaid.gov. So you're going to have to log into either or, depending on what your purpose is.
Can we get a copy of this presentation sent to us? If I can find your emails from your sign up page, I will email it to you. Or this presentation will be put into the advertisement for this program on Kansas City, Kansas Public Library website on our online programming blog. So go to kckpl.org and look for online programming blog on the first page. Click on it and you will see one of the programs listed will be more on student loans. Click on it and you will see the posting for this program. It should be there by tomorrow. If not tomorrow, then Monday, definitely.
Yeah, good. Definitely, I would look at the recording. That way you can get everything. And I'm happy to share the PDF, but the recording may be the better option for most people. Next question is, if we're in the pay-as-you-earn plan and the loans have been in forbearance, am I getting credit towards public service loan forgiveness? The answer is yes. Okay. The payments that you have not been making, this is one of the amazing things of the forbearance, the COVID forbearance that we've been in, is those payments that you're not making qualify towards public service loan forgiveness. It's also my understanding, I haven't looked at this guidance in a little bit, but they also qualify for long-term loan forgiveness within an income-driven repayment plan. Yeah, so that's awesome. It really is. Now, if your loans didn't qualify, then for the forbearance, then you have other issues, okay? But if you were not making payments and you were at 0% payments, 0 interest, then your payments have been qualified for during that time for PSLF. So you've gotten over 3 years of payments when you've made no payments, which is awesome. Someone said that they're having issues with minor problems with the PSLF paperwork. I'm not sure I have a specific answer for you on that. I don't do paperwork when I work with people on student loan plans, and so I don't have a lot of experience filling out paperwork personally. I can tell you I haven't gotten a lot of feedback from clients about being rejected regularly 5 times. So I don't know if I have an answer to that necessarily. I would try again, though. I certainly haven't heard a lot of those issues recently, and a lot of things have gotten better over time with some of these programs. And I will tell you, some of the things have gotten worse, okay? Servicers are really struggling to keep up with all these programs, and they have not gotten an increase in allocation of funds to do so. And so many of them are extremely overwhelmed. Not uncommon to try to call your servicer and sit on wait for like 3 hours. So it is what it is. Some things have gotten better, some things have gotten worse.
Did any of the time our loans were deferred during this freezing period count towards the PSLF?
Yeah, just answered that one. That's true. They will count.
Okay.
Okay, someone else asked below.
I applied and was accepted to the PSLF program last year, but I'm no longer working at a qualified employer. How does this affect my repayment forgiven options?
Yeah, good question. So your forgiveness options, that of course changes, and that you're not going to be making qualifying payments towards public service loan forgiveness. Now, what I said earlier still applies, though. It's 120 qualifying payments. It's not 10 sequential years, okay? So let's say, I don't know, you got 3 years qualifying payments towards public service loan forgiveness. You take a hiatus and you go work for a corporation for 2 years. You come back and you finish 8 years, or what did I say, 3 or 2 years, I forget, but you finish the other, 7 or 8 years on public service loan forgiveness, you can still get PSLF. And so it's not that those go away. It's just that you can't get it while working for a corporation, right? You're not going to be making qualifying payments during that time frame. The other thing you asked is on repayment. Does that change like the fact that I'm on pay as you earn or revised pay as you earn or whatever income driven repayment plan you are? And the answer is no. So those are two separate things, because you got to think like every federal student loan borrower is given an opportunity to pay under the plans that they qualify for. Not everybody that has federal student loans is going to go work for a nonprofit and try to get PSLF. So the income driven repayment plan you're in is not tied to the fact that you're in PSLF. It's there. Those are mutually exclusive concepts. Good question.
When I tried changing it to an income-driven plan pre-pandemic, the payment amount was way higher, and I don't make a whole lot. It didn't make sense to change it.
Yeah, I would, in this scenario, go back to that loan simulator at studentaid.gov, log in, and see what it tells you you qualify for. The other thing that I would say is keep an eye out for the SAVE plan. It's likely going to be, well, it may be beneficial for you given your situation. So I would log in and see what that calculator tells you, because that doesn't make a ton of sense that your payment would have shot up, but there are maybe some reasons why that would be the case given your specific scenario. But of course that is not the norm that would happen.
Is there a certain code number that represents the unified government that we will have to enter to apply for PSLF? If so, what is it?
Yeah, I don't know the answer to that specific question, but what tends to happen is your employer is certifying your employment. And so I would contact your HR, because let's say you do work for Unified Government of, what is it?
Wyandotte County.
Wyandotte County, thank you. I'm grasping at straws at this point. So Wyandotte County, then I can guarantee you the HR program, HR department where you're working at has done PSLF paperwork for someone else. And so just contact your HR department. They can likely walk you through it, and they probably have experience doing it.
If we were not making payments during COVID and these months qualify, how can we view how many payments we have made?
Yeah, so your student aid dashboard will show you, so that's studentaid.gov, will show you qualifying payments towards public service loan forgiveness, but they're not going to be, well, let me think. I may be wrong on this, but I don't think I am. They're likely not going to update it in real time, okay? So if it's been a while since you filled out public service loan forgiveness paperwork, this is why I encourage my clients to fill it out regularly. So I would encourage you to fill out PSLF paperwork again, and that will kind of guarantee that it's going to be updated and current for you in your dashboard.
Thank you. Will we receive notification of when we need to recertify for pay so that we know what our payment will be come October?
Yeah, so the servicers are required by law to notify you that payments are going to restart. So you should be looking out for some type of notification from your servicer that payments are going to restart. There's likely going to be additional detail on what that will look like for you individually. So be on the lookout for that. There was another piece to that question I was going to go with, but let me think. Yeah, I think, no, I think that's it. I think that probably answers it. If not, leave another comment. I'm happy to finish the loop on that.
I have been out of school for over 20 years. Does that make me eligible for long-term loan forgiveness?
Maybe, maybe not. So long-term loan forgiveness is a concept for income-driven repayment plans. So let's say you're in the standard plan, you've maybe had long periods of forbearance, you've maybe consolidated. There's who knows what you've been doing during those 20 years. I can't tell that without like looking at a data file or talking to you. But the answer is maybe. The other thing that makes this a little more complex is some plans, depending on whether you have undergraduate or graduate debt, the period for long-term loan forgiveness can be 20 years. It can also be 25 years. So you could be in, let's say, revised pay as you earn with graduate debt, and your period for forgiveness is actually 25 years. So I can't really answer that without knowing your specific situation. The answer is maybe, or maybe not.
As a recent graduate, it sounded like the PSLF is no longer an option without the waiver. Did I misunderstand that? What did the waiver that ended in October 2022 do?
Yeah, so the answer is PSLF is still around. The waiver was just a temporary program to try to rectify the fact that PSLF has historically been a train wreck. Okay, that's the easiest way to summarize it. PSLF was not a great program in terms of accepting people at the beginning. And so what the waiver program did was it gave people an opportunity that had essentially thought they had made qualifying payments and didn't for one of those technical reasons that we covered in this presentation, an opportunity during a limited period to rectify that where they would get credit for those things that weren't historically qualifying. So that's the easiest way. It's kind of a retrospective looking program to, for instance, let's say you had an FFEL loan. Well, we've learned in this presentation that those loans do not make qualifying payments because they're not direct loans. And so the waiver gave you a limited opportunity to consolidate FFEL loans, make them direct loans, and get credit for all of that back time, even though they wouldn't be qualifying normally. So it was kind of a patch program, and that program ended. But like I said, if you look at the waiver and you're like, man, I wish I would have gotten in that program, I would have had all these benefits. Well, then look into the IDR adjustment waiver, because you might be able to do the same thing in that program and not really realize it.
For those of us who are currently applying for federal aid, is there an advantage to applying for federal versus other types of loans, Pell Grants, etc., with the changes to repayment options?
Well, so that's there's a couple things to that question. So one is, if you're getting federal student loans today, they are going to be direct loans. So like Perkins loans don't exist anymore. You can't get them. Now there are grants that come out of the FAFSA, and of course you should take free money that you don't have to pay back before you take out money that you do have to pay back, i.e. loans. Okay. But I will say, outside of kind of that scenario, of course, there's an advantage to taking federal student loans over like going down the street and taking some out from a bank. And I've told you just why. You've gotten 45 minutes, of why they're beneficial over private student loans. Because what I told you about private student loans was 2 bullets. The benefits that I told you about your federal student loans were like, what, 20 slides? And so I do encourage people, and I do college planning as well in my practice. I encourage individuals to maximize student loans, especially the undergraduate borrowers. Now, well, let me clarify, okay, because I know what I'm saying. You don't know what I'm saying. I encourage people to maximize like undergraduate student loans, but they're maxed at like 27,000, 31,000 if you go longer than 4 years. I don't encourage you to like max out Parent Plus loans at high interest rates, okay? That's a different scenario. But for like the normal undergraduate borrower that is getting below market interest rates and their federal unsubsidized student loans and they're capped at 27,000, yeah, I would take that out if I needed the money. So hopefully that answers your question. I'm not saying that you should go Wild West and take out like high interest Parent Plus loans, okay? I've seen some really scary scenarios play out for that. But for undergraduate borrowers, a lot of times those loans are very favorable compared to what you would get from a bank.
If we have not been granted PSLF yet, should we start on income-driven repayments prior to getting approval?
Yeah. I mean, if it's a good fit for you, generally, there's no reason not to. Again, you don't necessarily have to be, you don't have to necessarily start one before the other. Now, a lot of people are doing both at the same time. If you were in the standard plan, you're like, hey, I'm going to go for public service loan forgiveness. A lot of times they're filling out public service loan forgiveness paperwork and they're switching to revised pay as you earn or pay as you earn or whatever it is, whatever's the best fit for them. Or, in the future, the SAVE plan. But yes, I certainly, if it's a good fit for you, I mean, why wouldn't you be in an income-driven repayment plan? Again, the payment plan that's right for you does play with whether you're in public service loan forgiveness, but there's lots of people that don't have public service loan forgiveness that are in income-driven repayment plans for different reasons. So I don't really see a reason why going into it beforehand would be a problem, if it's a good fit.
Another message. In trying to maximize PSLF, would it be better to consolidate multiple smaller federal loans into one large loan?
Oh man, this is where I say buyer beware. Okay, so you only my thought is you only consolidate when it's necessary to do something. You don't consolidate just because you're making payments on tiny loans or things like that, and it's a little bit aggravating. You consolidate because, like under the waiver program, when you consolidated, you were able to get qualifying payments on an FFEL loan. Like that was a very compelling reason to consolidate. Under the waiver, the IDR account adjustment, you might consolidate because you have more qualifying payments under one loan than the other. And when you consolidate together, you get the most payments under both those loans. But I can tell you, if you consolidate with no reason outside of a plan, it can erase all your payments. And so all your qualifying payments, because they're issuing you a new loan. So big buyer beware, do not consolidate unless there's a reason to consolidate. You know what that reason is, and you know there's not going to be any adverse consequences for doing so. Big warning sign flashes, okay? Be careful.
So since I have no payments yet, does your warning still stand?
Not necessarily, no. And actually there's reasons to consolidate to start the clock, actually. There are many, for instance, medical school students that will consolidate their loans immediately to waive their grace period so that they can start getting qualifying payments sooner than 6 months when their grace period expires. And so you're in a little bit different of a situation. Again, I don't like to give specific advice until I know the entirety of what's going on in your scenario. But if you don't have any qualifying payments, you're just getting out of school, there's likely not going to be as much of a penalty. But if you had 6 years qualifying payments towards public service loan forgiveness, I would say do not consolidate unless you have a very clear and compelling reason and you know what you're doing.
I believe these are all the questions, unless people want to ask them again. I'm not seeing anything in the chat. That means you answered all the questions perfectly.
Great. Well, I don't know if they were perfect, but hopefully close enough that I didn't lead anybody astray.
Well, thank you very much, Jason. That's been a great presentation.
Thank you all, and thank you for having me back. Email me if you have any questions.
Thank you, everybody, for attending this wonderful program, and keep your eye on the recording of this program on Kansas City, Kansas Public Library website at kckpl.org. Programming blog, online programming blog. There will be a recording right where the advertisement for this program is. Thank you very much, and everybody have a great day. Thank you, Jason, again. Thank you.
Thanks, everybody.
Thank you.